Welcome, everyone. Just want to give a little intro to those of you who might be new to joining us. So this is another self-directed and solo 401k Q&A question. My name's Mina. I'm the Director of Accounts here at Sense Financial and work with the clients who join us and helping them to get set up. For Sense Financial, we're a boutique financial firm, and we specialize in establishing self-directed retirement accounts with checkbook control. We're going to, again, kind of launch into the questions that you submitted. I do want to give an intro to Dmitriy. Dmitriy Fomichenko is the founder and president of Sense Financial Services, and he began his career in financial planning and real estate investing in 2000. He owns multiple investment properties in various states. He's a licensed California real estate broker, and he also holds a designation of certified IRA services professional from the American Bankers Association. And over the years, Dmitry's taught hundreds of investment and financial planning seminars. He's mentored thousands of investors. Dmitry, welcome, and thank you for joining us today.
Mina, it's great to be here with you, and thanks for the warm introduction, and looking forward to diving in and answering those questions.
Perfect. Well, I actually thought that I might start us off with talking a little bit about terminating a solo 401k plan. It's a question that we get time to time, kind of what is involved in that. So I thought it'd be good to just kind of touch on a few points with that, and maybe I could just mention a few things, and then Dmitry, if you'd like to chime in on any additional thoughts, yeah, that would be great.
Yeah,
so yeah,
topic. We actually had some people get in trouble a little bit with that, so thanks for bringing that up, Mina.
Oh, absolutely. So like I said, I'm the Director of Accounts here at Sense Financial. So this is a topic that, comes up once in a while. So just a couple things to keep in mind. When you are terminating a solo 401k plan, keep in mind that the plan is not kind of considered fully terminated until all the assets of the plan are distributed. We sometimes have folks who ask us, they want to kind of end their service, but they still have assets within the 401k. As long as you've got the assets in the 401k, then like I said, the plan is not considered fully terminated until it's emptied out. So that's like one thing that you want to keep in mind with a solo 401k termination. Another thing that you want to remember is when you terminate a plan, a solo 401k plan, you are responsible for certain filings on behalf of the plan. Two come to mind. One is a 1099-R, and that's what you would file on behalf of the plan anytime assets are distributed. So if you do like a personal distribution, you would need to issue a 1099-R from the plan. If you do a rollover from the solo 401k to another retirement account, you'll also need to do a 1099-R. It'll document that, of course, as a non-taxable event, but it does still need to be reported to the IRS. So that's kind of filing number one, the 1099-R. And then the 5500 EZ, which I think you're probably familiar with if you have a solo 401k. The 5500 EZ is kind of a short informational return filed on behalf of the solo 401k to the IRS. It is required in several cases. One, when the value of your plan hits $250,000 and above, then the 5500 EZ is required. But it's also required when a plan is terminated. So the IRS basically wants to see that you've emptied out the solo 401k. So if you remember on the 5500 EZ, column one, you give the value of the plan at the beginning of the year, and then you also give the value at the end of the year. The IRS basically wants to see that that end of the year is zero. So it's kind of been emptied out. But yeah, the 5500 EZ is the second filing that you would need to do on behalf of a terminated plan. Those are kind of the top two thoughts that come to my mind, Dmitry, but do you have any other input
Yeah,
any other
thanks,
things like that?
Nina. I think the problem that we've seen people run into is that they don't distribute the assets out of the plan when it's terminated, and they don't file the appropriate forms, and that really can get you in trouble with the IRS, because IRS, if they spot this, they will consider your plan no longer qualified. So you can be taxed on the entire balance. So it's going to be no longer considered a retirement plan. So be sure to follow our guidance on this. If you want to terminate the plan, we can guide you. Just you got to make sure that you follow those steps so that you stay out of trouble with the IRS.
That's right.
All right. Well, let's jump in. And before we do, actually, I just want to remind you all that we will go over the questions that were pre-submitted first, and then we're going to go over questions that you can submit now as you listen and think of something. You can go to the Q&A section and just type your questions there, and we'll get to those after.
That's right. So I'll jump into the first question. The first question is from Gabriella, and she asks, when is the time to open a Roth 401k, and what is the minimum contribution for it?
Gabriella, good question. You can set up a solo 401k, and when the solo 401k plan is established, every plan that we establish comes with the Roth provision. So there is a Roth provision that is built into your plan documents. And it is there for you, whether you use it or not, it is there available for you. And as far as the Roth contributions, you can choose to contribute your elective deferrals, because there are two components when it comes to contributions. The elective deferrals, what you contribute as an employee of your business, and then profit sharing. The employee component, you do have the ability to make contributions as Roth post-tax, and there is actually no minimum. There is maximum $23,000 for this year is the maximum contribution. Plus, if you're over 50, you can do a catch-up contribution, another $7,500, but there is no minimum. You're not required to contribute to Roth 401k, but there is a maximum. Good question, Gabriella.
Great. The next question we have is from John, and he is interested in using an LLC for a Roth rollover to invest in rental real estate. Can you provide any details?
John, I think your question needs to be clarified a little bit. So I'm not sure what your situation is. If you have money in a Roth IRA or Roth 401k potentially, then yes, you can roll those over. They're not rolled over into an LLC. They will have to be rolled over into a self-directed plan, either self-directed Roth IRA or self-directed solo 401k with the Roth component. And that's actually to reflect back on the previous question Gabriella asked. You can take the Roth 401k funds and you can roll them over into a solo 401k Roth plan, or you can also do a Roth conversion. But in case of John, you can roll it over, and then those funds can be self-directed, including investing in real estate. Some people choose to use LLC to hold the real estate, but that LLC will be inside of your retirement account. The process is pretty straightforward. Again, you first need to establish a self-directed retirement plan. Then you will process the direct rollover, meaning that you don't get to touch the funds that are coming from your existing retirement accounts. They're going directly to your either IRA custodian or directly into your 401k. And then if you want to use LLC to hold the property title, then it needs to be done correctly. Not just your regular LLC, it needs to be a special purpose LLC that meets the IRS requirements. We can help you with that, so feel free to contact our office and we'll be able to guide you. Thanks for the question, John.
Next question is from Cameron, and he wants to know a little bit more about solo 401k Roth limits. So his question was actually, what are the solo 401k Roth limits? I'm not sure if he's referring there to possible income limits, like with a Roth IRA, Dmitry, or the contribution, which kind of just talked about. But yeah, if you want to address either or both of those aspects.
Yeah, good question, Cameron. So there is no restriction on the income, unlike with the Roth IRA. With the solo 401k Roth, you can contribute regardless of your income. With the Roth IRA, there is an income limit, and you are not allowed to contribute to Roth IRA if your income is over a certain threshold. Not so with the Roth Solo 401k, but there is a limit on the contribution. I just addressed that. Again, it's $23,000. If you're under 50, and additional 7,500 if you're at age 50 or over, for a total of 23,500.
Great. Mark has the next question, and he wants to know, do I need to report my solo 401k?
Good question, Mark. There are several reporting requirements for the solo 401k, and certain things that we're responsible for as your document provider, and certain things that you're responsible for. So let me talk about what we're responsible doing for your 401k. As a document provider, we are responsible for doing a sponsor reporting. So once a year, beginning of January, we are required to report to the IRS all the sponsors that are using our prototype plan documents. So we handle that. You're not involved in this. It's not your concern. What your concern is twofold. There are two requirements. Number one, any contributions that you make to a solo 401k must be reported on your tax return, either personal, if you're self-employed and you're filing on Schedule C, the profit sharing contributions will be reported on Schedule C. If you're incorporated or LLC taxed as an S Corp, then you will have a separate report for your corporation, and the contributions that are profit sharing contributions will have to be reported on that corporate tax return. So that's number one. The contributions are reporting your responsibility, and that's something that your CPA will help you. Any CPA should be able to help you with reporting those numbers. You just provide the numbers to them, and they plug those into your tax return. It should be pretty straightforward. And then additionally, you're required to submit annual report using Form 5500 EZ. This report is required if your total plan assets, and that's everything in your 401k, cash, all the investments, and that's for all the participants. So if you have two participants, you and your spouse, you have to add everything up because you're part of the same plan. If the total plan assets exceed $250,000, you must submit this report. It's pretty simple and straightforward. We will help you with that. We'll send you a reminder to do it, but you got to complete that. 2 pages. Might take you a little bit of time to complete it first time, but then all the subsequent years should be pretty easy because you go off of previous years and you just update the numbers. The main section there is the plan assets. So that's really what you need to pay attention for. And as Mina mentioned earlier, when your plan is terminated, you're required to submit that reporting as well. And while you're not required to do it if your total plan assets below 250, we do recommend that you do it. Number one, you get a statute of limitation going, and which is 3 years. Otherwise, IRS can go back and audit you 20 years back. So it's nice to have that, and it's just good to establish the record with the IRS. So we recommend that.
Perfect. Just to go backwards just a little bit, Cameron was the one who had entered the question about the solo 401k Roth limits, and he entered a follow-up question in the chat, which was, please go over mega backdoor Roth requirements. I thought this would be a good opportunity to go over that since we just touched on his question a little while ago.
Well, sure. Thanks, Mina, and thanks, Cameron. Yeah, so with the solo 401k, you do have the ability to contribute what's known as a mega Roth. And mega Roth is you can contribute on top of your elective deferrals and profit sharing. So the total limit for this year is $69,000. And let's say you contribute 23,000 as elective deferrals, and then you put additional 20,000 as profit sharing, again based on your compensation. So you're at $43,000. Well, you still have another 26,000 potentially that you can contribute to max up your limit for the year, and this additional $26,000 can be contributed as after-tax contribution. So they're not tax deductible. You already pay taxes on those funds, but you can put them in what's called the after-tax account. So you got to put them in a separate bucket, but you can immediately convert them to Roth, and it will not be taxable then because you already pay taxes on that. So essentially, that's how you. That's why the mega Roth term exists, because you're just piling a lot more money into a Roth bucket by utilizing this strategy. So that's how it works. So thanks for the question.
Yeah, thanks for that follow-up question, Cameron. Next question is from Eden, and she entered self-directed IRA and its tax consequences. We might need a little bit more information on that, but Dmitry, if there's kind of any general thoughts you'd like to touch on?
Sure, Eden, we can provide you with general answer. We would like to know if there is a specific situation that you're referring to, but generally speaking, self-directed IRA is an IRA. An IRA is a tax-deferred retirement vehicle, and it is tax-deferred. So all the gains, all the income, all the investment returns that you make with self-directed IRA, they're sheltered from taxes. So there is no tax consequences to you until you start taking distributions. But in some cases, there might be tax consequences, and two that you need to be aware of. Number one is when you acquire real estate using leverage. So if you buy a rental property and you get in a loan, you must use a non-recourse lender to do so. The income that is derived from the leveraged portion of the property is subject to what's known as UBIT, unrelated business income tax. And so be sure to review those numbers with your CPA. By the way, if you do that inside of a 401k, 401k is exempt from the taxation on leveraged real estate. So it's just supercharges your wealth creation. And then a second instance when the UBIT applies, when you invest in a business enterprise. Retirement accounts are designed to be invested passively. So if you invest in an active business, the gains from that business activity will be most likely subject to unrelated business income tax. So be sure to aware of that and make sure to invest passively. That's what our recommendation. And if you do invest in an active business, like flipping, for example, which comes up often, then if you do it on a repeated basis and there's a number of those that you do, then most likely you will be subject to UBIT. So talk to your CPA.
Since we're on the topic of checkbook self-directed IRAs, Dmitry, it might be a good opportunity to address some of these questions from Hung, who submitted them in the chat. One was, how does a checkbook self-directed IRA work, and what are the reporting requirements required for the custodian of the IRA?
Yeah, so the checkbook IRA, in a nutshell, is self-directed IRA and steroids. So you have a custodial IRA. You do need a custodian for every IRA, and you're a conventional retirement account, conventional IRA with which will have a custodian such as Fidelity, Schwab, Merrill Lynch, or Wells Fargo. The self-directed IRA has a custodian that does not place the restrictions on the investments that you make with your IRA. So you can buy real estate, for example. But you still have a custodian between you and your funds, and you have to go through the custodian for each transaction you make. So many investors find that inconvenient, and that's when they actually opt in for a checkbook IRA. And in this case, the special purpose single member LLC is established. This LLC is owned by the IRA, and it is managed by you, the account owner. So that gives you checkbook control, quote unquote, right? So with the checkbook control, you don't have to go through the custodian, through the middleman. You're able to bypass them, and you make investments directly inside of the retirement account. So that's how it works. And what was I think there was a second part of the question, Mina.
That's right. Hung also asked or described he currently has a 401k and a pension plan from an old company under one custodian, Fidelity. Can he move those funds over to a self-directed IRA? And if so, what's the normal time frame to complete that?
Oh, I see. Okay. Yes, if it's with the past employer, you can move that account into self-directed. Should be no restrictions there. The restriction might be if it's with the current employer. If you're still employed, there is a term in service, so meaning you're still employed, then there might be restrictions for in-service distributions. But if you're no longer employed, you typically can move those out. If you're talking about checkbook IRA, typically it takes about 4 weeks to establish. There are 4 major steps. So it's not a quick process. It takes some time to get everything set up. But once it is established, you are in full control of your retirement funds, and you can make investment immediately. It can be as simple as writing a check or just doing a wire transfer from your checkbook IRA account.
Perfect. And one more question related to the self-directed IRA from the chat is, for a self-directed IRA, what are the guidelines for non-involvement or non-active business? And that's from Jeff.
Well, it has to be hands-off. It has to be arm's length transaction, and that's the term that is used in kind of legal term, arm's length, meaning that you're not involved in the transaction, so you cannot be involved. Let me give you an example. Again, common example, I did mention that earlier, is flipping a property. If you flip a property inside of your IRA, it's possible to do that. There might be tax consequences because flipping generally will be considered an active business. So you can buy the property in your checkbook IRA. You can the property can be rehabbed, and then you can sell that for a profit, but you cannot do any work. You, yourself, and any other disqualified person, and disqualified person is defined by immediate family members. So yourself, your spouse, your kids, grandkids, and their spouses, your parents and grandparents. So those will be disqualified persons. Those individuals cannot be involved in the transaction. You cannot do any. You can swing a hammer and do the work on the property. You cannot be providing any services otherwise to the retirement plan. For example, if you're a real estate agent, you cannot act as an agent on that transaction. You have to give it to someone else. If you are a handyman or a contractor, neither yourself personally nor your company cannot be involved in that transaction with your retirement account.
Thanks, Dmitry. Margaret also wants to know information about the proper setup to invest in stocks for a self-directed IRA. Do you have any thoughts on that?
Sure. Margaret, self-directed IRAs, they're typically designed or the intention is to invest in alternative assets. So if you want to invest in stocks, then you probably should stay with where you're at with your existing retirement accounts. But if you maybe you made some alternative investments, you're receiving some cash flow, and if you want to put that into some stocks, then you will need to, you can do it with a custodial IRA. You need a checkbook IRA, and the checkbook IRA is where you establish a special purpose LLC that is inside of an IRA. So it might be possible to do it with this setup. You can open a brokerage account in the name of the LLC using LLC tax ID number. So it will be inside of the LLC or under that LLC umbrella. You can have checking account, you can own a piece of property, and you can potentially set up a brokerage account in there. But what we found lately, though, over the last year or so, that some brokerages, they're actually want to stay away from those, and they don't open account for the LLC that your IRA owns. There is still at least, I think, one or two that will do, but it is possible that way only.
Good. And just following up on what you mentioned before, Dmitry, Kevin wants to know, is a brother or sister considered a disqualified person if they were the contractor?
Yeah, good question. Well, brother and sister is not in that list that I mentioned. They're not considered immediate family members, which again, if you remember, vertical line. Okay, so your parents, grandparents, your kids, grandkids, and their spouses. So your siblings are not considered disqualified, and your IRA can engage in a transaction with a sibling or uncle, nephew, cousin. That's possible. They will not be disqualified.
Tom has the next question of, how will Camala Harris's tax policies affect our self-directed IRA? Will we have to take out every year to pay?
Well, Camala Harris doesn't have any tax policies yet. I'm not sure exactly what she's proposing, and that will be a question to tax experts, I guess. So I'm not able to answer this question because, again, we can only speculate, and so there's no policies in place yet. So I think we'll have to wait, and we are doing tax events at least a couple times a year. So Tom, I would encourage you to attend our next tax seminar and ask a tax expert this question. But that's
Great.
our
Going back to the topic of a self-directed solo 401k, Tiffany wants to know, how can you lend out of a self-directed 401k?
Tiffany, this is very common. Private lending with your retirement funds. This is something that is my personal favorite. I prefer to do that. I rather be a lender, and I've done it a number of times, and it's pretty straightforward. So you are lending. My recommendation is always do a secured loan. Don't do just a personal loan because you're risking your retirement account. So always make sure that it is a secured loan, meaning that you're lending against the property, and property serves as a security for the loan. So you can always recover your capital in case of a problem. But your 401k will be the lender. You will need a promissory note that spells out the terms of the loan, and then you will need a deed of trust or a mortgage that secures your interest. You typically would work with a broker. That's what I do personally. And if you're doing it like to maybe someone that you know, if there is no broker involved, then make sure that you have a title company or escrow company that handles the transaction, and they will handle the documents set up properly.
Great. That's some great information about lending from the solo 401k to an outside party. This is a little bit of a different aspect, but Mason wants to know, what's the process for borrowing against my 401k?
Good question. Can you borrow against your 401k? No, you cannot borrow against your 401k, but you can borrow from your 401k. All right. So Every 401k plan that we establish comes with the loan provision allowing you to take a participant loan up to $50,000 or 50% of your account balance, whichever is less. And the loan process is very simple, but again, you're taking not against your 401k, you're taking from the 401k. So you're actually depleting the balance in your 401k. That's why you need to be careful weighting the kind of if it's a good decision, because you will be depleting the balance that is in your 401k that otherwise can be invested, and it can be invested on tax deferred basis. But we do provide detailed guidance for this. You simply want to log into the client portal, go to the maintenance tab, and then go to the click on the participant loan. The loan application and the process is spelled out there. So do that, and you can then provide us with the copy of the completed application. We can review it for you, make sure it's done correctly, and you'll be ready to write yourself a check for the loan.
I've got two questions that are a little bit related, so I'm going to read them both to you, Dmitry, and then you can take one at a time. One question is from Mike, and he asks, what is the requirements to set up or start a solo 401k? And then the kind of related question is from LJ, who emailed a question of, does Sense Financial assist in setting up the self-employed business like an LLC? So would you like to start with the first one, the requirements to set up or start a solo 401k?
Yeah, so the requirements for the solo 401k is twofold. Number one, you have to have legitimate business or self-employment activity that generates earned income. And you need to understand the difference between earned and passive income. Often people come to me and say, well, I do have a business. So I start asking them, what kind of business do you have? I have a real estate business. What it is? I own 10 rentals. If you own 10 rentals and you receive rental income, that's passive. So that's, in the eyes of IRS, that's insufficient. It doesn't, it's not active business, actually. So you have to have active business that generates earned income. An example can be being a real estate agent. So if you're a real estate agent and you receive commissions for helping people buy and sell real estate, that's earned income. If you're some kind of consultant and you are charging clients a fee to do some kind of work, well, that's earned income. You report that on a Schedule C, or you might have corporation set up, that's earned income. So that's number one. And number two, you must not have employees in your business. You can actually have part-time employees. Usually you got to keep them under 500 hours a year. That's a possibility, but you cannot have full-time employees working for you, because by law you will have to offer them retirement benefits as well, and solo 401k then will not be an option for you. So twofold. And the related question, do we assist in setting up self-employment business? No, we do not. That's not our expertise. You gotta probably get with your CPA, talk to your perhaps tax advisor or attorney, how to properly structure your business. We can perhaps provide you with some general guidance. I've been in business for over 20 years, and often I can kind of brainstorm with clients when I talk to them, and I can give them some guidance. But again, I'm not. That's not my area of expertise. Our area of expertise is self-directed retirement plans.
Next question is also related to the solo 401k. This is from Yusria. And she asks, can I open a solo 401k for my LLC in the same year I maxed out contributions to an employer plan?
Good question, Yusria. If you have a company retirement plan with your employer, and you can establish a solo 401k completely independent from that. You can have more than one 401k plan. Again, you must qualify for that. You must have a legitimate self-employment or activity or business that generates earned income and no employees. in your business. So you can have employer plan with your employer, and then you can also have a solo 401k plan. Now, the contribution part, something that you need to understand. With solo 401k, there is two contribution components. There is employee elective deferrals, and the limit for that is $23,000 plus the catch-up. And this contribution is subject to a single limit for all the plans that you may have. So if you have employer plan and you maximize the contribution there, you can no longer contribute as an employee to your solo 401k. However, with the solo 401k, there is a profit sharing contribution, and that is specifically for the solo 401k plan. So regardless of your contributions to your employer 401k plan at work, if you're eligible and you have income from your side business, you can contribute profit sharing contributions. And the limit with the solo 401k is $69,000. So potentially, if you have enough income, you can potentially contribute up to $69,000 to your solo 401k, in addition to the 401k plan that you have with your employer.
That's right. So it's important to remember that for the employee contribution maximum, that's per person, not per plan. All right, next question is from Chuck. After PITI, maintenance, and MMD, how do you cash flow anything?
Chuck, I think your question is about investment. The PITI stands for principal, interest, taxes, and insurance. Maintenance. I'm not sure what MMD is, what you're referring there. Well, I'm not sure if I can answer this question because, what are you talking about? Are you talking about specific property, specific investments that you're making? And yeah, there are certain investments that may not cash flow. There are other investments that will cash flow. So it depends on the investment. So I'm not sure if I can tell you much more about that. I need to know a little bit more. Again, the question is not related to the 401k. It's related to some kind of investment property, I'm guessing. But Chuck, feel free to reach out to me directly, and maybe I can, after I learn more, maybe I can give you more information on that. But thanks for asking.
Thanks, Dmitry. Edmund has the next question of, can I transfer funds from my 401k to my self-directed IRA and still keep the 401k active going forward?
Good question, Edmund. Can you transfer funds from your 401k to your self-directed IRA and still have the 401k active? Well, it depends on the 401k. So if it's a 401k with your current employer, then typically you're not allowed to take the distribution from the 401k plan because you're still employed there. Now, in some instances, there might be exceptions. So you got to talk to your plan administrator and ask your plan administrator, is there in-service distribution provision that will allow you to take the distribution while the plan is active? So if it's with the past employer, if you're no longer working for the company that you have a 401k account with, then you can move those funds freely. So again, it depends on those nuances. So you got to talk to your plan administrator and see if that's possible. But a self-directed IRA will accept rollover from the 401k. So there is no issues there. There is no limitations there. The limitation is with your 401k. That's why you got to talk to your 401k plan administrator. But again, there is no restrictions on the IRA part. IRA will accept those rollovers.
A related question comes from Sam, who asks, how can I convince my employer to include the in-service rollover option inside the 401k plan?
Sam, before I answer that question, I just want to, I think we have a couple more questions left here on the list of the pre-submitted questions. So just want to encourage you we still have a few minutes left here that we can probably get more questions squeezed in. So type them in the Q&A. This is kind of your last chance here. But to answer your question, Sam, how can you convince your employer? Well, I don't know. Honestly, I don't know the answer to that question because it's not just your employer, it's the plan administrator and who provides the plan documents. So it's not just up to your employer. They might be limited there. But again, there might be some exceptions, typically depending on the years in service, depending on the contribution type, because typically if your employer offers matching, there is after a certain number of years, those amounts can be vested and you might be able to move those out. But that's about all I can tell you. So I don't have any trick, I guess, to convince your employer to provide that. I guess that's all I can say.
Tony has the question, please review the Solo 401k setup and fee structure.
Tony, good question. So the setup is, as we mentioned earlier, you have to have legitimate business in place in order to establish a solo 401k plan. So that it needs to be an active business that generates earned income. And the earned income is required, and actually not just the revenue, but the profit. You must have profit in order to contribute. Now, you don't necessarily have to have a profit to establish the plan. If you started a business potentially today, tomorrow you could establish a solo 401k plan. If you have a legitimate business in place, you can establish a solo 401k plan, and you can fund it with the rollover from another retirement account potentially. So you can fund that. You just will not be able to contribute until you actually have the profit. So keep that in mind. So number one is you have to have business in place. That business will serve as the sponsor of the 401k plan. Because solo 401k is employer-sponsored plan, there must be a sponsor. So your company or your business entity will serve as the sponsor. Now, you don't actually have to have the entity in place. If you're self-employed as a sole proprietor, essentially using your own name, so you as a sole proprietor can serve as a sponsor. That is sufficient. You don't have to have the entity in place. Now, once you do that, then you come on board, and then you will work with our team on getting everything set up. So Mina leads that process. You will complete a client questionnaire. We need just a basic information about you and your business. And then we start drafting the plan documents. Once the plan documents are established, you get the package, which you must execute. And then you can proceed with funding of the plan. And funding can be done, like I said, either with the rollovers from another retirement plan or contributions. And to do contributions again, you must have a profit in order to make contributions to the 401k. As far as the fee structure, it's pretty straightforward. We charge a flat fee of $600 to establish the plan, and then we charge a flat fee of $250 starting in year 2. And what that covers is all the plan documents, because you do need plan documents, and we provide you with the prototype that you can use and rely on that prototype and the IRS determination letter. And then we provide you with 24/7 access to the client web portal with everything you need to maintain your solo 401k plan. You also will have dedicated account manager, and we do offer unlimited client support. And that's I think probably one of the main things that separates us from the competition is the quality of the service that you will receive. Tony, if you're considering that, that's really our strongest advantage, I believe, comparing to everything else out there.
Just to chime in on that, Dmitry, as Director of Accounts, again, I'm involved in overseeing that process, and we really try to streamline it, make it very intuitive. And like Dmitry mentioned, we've got a team of folks here who are just more than happy to answer any questions along the way, and just be a support as you get your plan established.
All right.
All right. So now going into the questions that were submitted in the chat, we were able to answer a few of them already. But Cameron wants to know, this is for the Solo 401k contribution limits. He just wanted to confirm the limit of $69,000 is under 50 and over 50 is $76,500, correct?
Yeah, so $69,000 is the limit, and then 50 and over, you got $7,500 in the catch-up.
Perfect. All right. Next question is also from Cameron, and this was regarding the Roth mega backdoor. He wants to know, is there an immediate rollover from the pre-tax account to after-tax account? And then can I just set up a separate after-tax Roth account instead?
Oh, let me read it again.
Sure.
Immediate rollover from pre-tax account. Well, it's not a pre-tax account, Cameron. It's actually it's an after-tax account. So it is a separate account that you must open under your 401k or a bucket, if you will. So there can be a pre-tax bucket for your elective deferral contributions. There can be a Roth bucket for your Roth contributions to the 401k. There can be a bucket for your profit sharing contributions. There might be the same buckets for your spouse if your spouse is also a participant in the plan. But if you wish to do the mega backdoor, then you do need to open another, not a pre-tax, but after-tax account. So it's an after-tax account, separate account from all the existing accounts that you have, and the pre-tax, the after-tax contributions will go into that account, which you can then convert to a Roth, if that makes sense. And we actually have an article that Mina did on that. So it's pretty detailed, Cameron. So I do encourage you to log into the client portal, go to the knowledge base, find that article, and spend some time on it. Because it's a little bit involved process, so you want to spend some time making sure that you understand that.
Thanks for that, Dmitry. You beat me to the punch. I was just going to mention that article. Next question is from Hung. From my understanding, for a self-directed IRA without checkbook control, the custodian will need to approve and charge for each transaction. In regards to a checkbook control self-directed IRA, what are the reporting requirements back to the custodian or IRS? I think we touched on this a little bit, but if you've got any additional.
Yeah, so as far as the difference between a checkbook control and without checkbook control, the custodial account. So yes, without checkbook control, you have to submit a request to the custodian for each investment, but not only for each investment, but for each transaction that you do. So if you own a rental property in your 401k and you need to pay property tax bill or insurance bill, you have to submit those requests to the custodian, wait for them to approve it, and then they'll charge you a fee for that. So the checkbook control model eliminates all of that. But as far as the reporting requirements, you do not report transactions to your custodian, but you do need to report the value of the LLC to the custodian once a year. Typically in December, they will ask for the annual valuation. So you're responsible for doing that. For
our last question of the day is from MC. And MC asks, to follow up on the requirements for a solo 401k, what will happen to your solo 401k if your active business closes down? Do you have to close the solo 401k as well, or can you keep it open?
Yeah, so MC, you if your business shuts down, then there is no more sponsor of the 401k. 401k, as I mentioned earlier, again, it's an employer sponsor plan. There needs to be a plan sponsor. So it can't exist without the sponsor. So the proper way is to either terminate the plan, or if you can maintain some sort of self-employment activity, but just maybe under your sole proprietorship, that's possible also. So if you close your entity, but you continue some business activity as a sole proprietor, then we can amend the plan and remove the entity that is no longer there, but change that to your sole proprietorship. If you do it that way, you can keep the 401k open. Otherwise, you will have to terminate the 401k plan. And if you have alternative assets there, you will have to move them to a self-directed IRA.
Great. Well, that concludes our questions that were submitted for today, Dmitry.
Mina, good questions. Thanks for your help getting to all those questions. I enjoyed them, and thank you all for joining us today, and we look forward to seeing you next time.